I when I read this year's letter from Buffett, and I thought about his 12 great decisions out of the 200. I would say out of the 200, just outright mistakes where he lost a lot of capital would be very small. But a lot of businesses which either flatlined or had some loss of capital would be a fairly large number. So one of the important lessons that comes up from Buffett and his letter and his approach is what I would call, the circle the wagons approach to investing. So basically, Buffett has a incredible record in the sense that he has compounded at 19.8% annually for 58 years, which is two times the rate of the S&P, which is at 9.9%. And the 9.9% compounded for the S&P has led to a 24,700% increase in value. But the 19.8% for Buffett has led to a 3.8 million percent increase in value. So it's just not even in the same zip code. So even though he says that, most of my decisions are so, and, when we look at those 200 decisions, we'd be scratching our heads over many of them. And many of them we would obviously say, well, I would have never bought it, and such. Even with all of those warts and everything else thrown in, the overall results are incredible. And the reason the overall results are incredible is because the flowers were never cut and the weeds were never watered. And so that's a really important lesson here. So what I mean with that, and I think somewhere in the letter he brings up something about the flowers and weeds. I don't know if I can find it on the fly over here, but I'll see if I can find it later because he has some quote about that. So basically, if I just switch gears a little bit, in the early 1970s, there was this concept of investing called the Nifty 50, where the idea was that you bought these 50 tremendous businesses, equal weights, 2% in each, and you kind of set it and forget it, and you made a lot of money. And the idea of the Nifty 50 was that you really didn't care how expensive the business was. It was a great business, you bought it. And so, for example, McDonald's was in there and Procter and Gamble's in there, Xerox and Kodak and all these different businesses that were really kind of strong and powerful, IBM and so on at that time. And the Nifty 50 became so popular that those businesses went into stratospheric valuations. And then in 73, 74, when we had the big, huge downturn in equity markets, the Nifty 50 got taken out back and shot, and very little was left of that portfolio. It was decimated. There's some controversy about whether Walmart was part of the Nifty 50 or not. There's one group of people who think that Walmart was part of the 50. There's another group of people who think it wasn't. But let's go with the side that thinks that Walmart was part of the Nifty 50. So if you bought the Nifty 50 at whatever ridiculous valuations it was trading at in the early 70s, and you went through the whole 73, 74 downturn and never touched those 50 positions, and you assume that 49 of those 50 positions went to zero, except Walmart, you ended up trouncing the S&P from 1970 to now by some significant margin. Like, you'd be about like 4 percentage points over the S&P. So I'm taking $100. I'm lighting fire to 98 of those $100 and taking those to zero. I'm left with my $2 in Walmart. And my $2 in Walmart beats the pants off the S&P. And so that kind of data is somewhat in sync with Buffett's record. The thing is that some of these investments he made are like holding Walmart for 50 years. They like that. They just had such powerful economics. There was a very good investor in India who passed away recently. He had a lot of health problems. He didn't live that long. He passed away when he was 62 years old. And Rakesh Jhunjhunwala, and he basically never managed outside capital. He didn't have any money when he started. He actually borrowed I think about $10,000 from someone to buy a few stocks at 18% a year or something. He was paying that person. And he didn't have any collateral when he was borrowing the 10,000. The person said, "How do I know I'm going to get this money back?" He said, "I'll put the stocks in your name so that you know that you have those, and I have the economic ownership. But if things go to hell and I can't pay you, you have ownership of the stocks." And of course, he was able to pay him. But when Rakesh passed away, so he never managed outside money, never started a business or anything like that. When he passed away last year at the age of 62, he was worth about $7 billion. And half of that 7 billion, about 3.5 billion, was one position. It was a company in India called Titan Industries, which is a jewelry retailer and manufacturer. And about 25 or 27 years ago, Rakesh had put 4% of his net worth at that time into Titan Industries. And he was a hyperactive trader where he'd sit, with 3 screens and be in and out of all these positions all the time. But there were 3 or 4 positions he had that he never touched. He just kept them forever. And Titan was one of those positions. So if you do the same thing with Rakesh's portfolio, where you torch 96% of the portfolio in the mid 90s when he bought Titan, he still ends up with 3.5 billion. And so that's very similar to the Nifty 50. So I think the lesson in investing is that it is a very forgiving business. I mean, if you look at the Nifty 50, you could have been wrong 98% of the time, 49 out of 50 times, and you still did okay. Now, you wouldn't have done okay if you danced in and out of Walmart stock. Wouldn't have worked. And in the last 50 years, nobody held Walmart stock. Nobody held Walmart stock for the entire 50 years, except the Walton family. And so here was this great business. It was obvious it was a great business. It was doing well. It was embryonic. It was growing like crazy. And people didn't hold on to it. And so the key with investing, in my opinion, is not so much that we won't make mistakes. We are destined to make a ton of mistakes. It's just the nature of investing. John Templeton said the best investment manager will be wrong 1 out of 3 times. Probably more likely will be wrong half the time. If you look at the 200 bets Berkshire made, I would say probably a good 100 would be mediocre or poor and still didn't matter. But the concept that matters a lot is the concept of circling your wagons. So you don't really know a business till you invest in it. And it really takes you a few years of ownership to really understand the business. You may have some ideas about the business before. It's when it drops 40% in price after you buy it, that's when you get a real education of what the business is actually all about and what it's worth and everything else. Your analysis will be extremely good at that point. It won't be so good before you buy the business. It'll be really, really good when it drops 40%. You'll be amazing at it. So the important thing is that all of us will find ourselves in the happy situation every so often of holding a small interest in a great business. And when that happens, what you need to think about the portfolio in the form of a few concentric circles. Okay. So at the very center of the circle, with a bunch of wagons circling around, if we go back to Rakesh Jhunjhunwala, is Titan Industries. And the next round of positions with a bunch of wagons around it would be bets that he has less conviction on. He might have like 3 or 4 others that he feels pretty good about, but not as good as Titan. So he puts, they're in the next circle. And then you might put the next set of positions in the next circle. So one of the things I would encourage you to do is that the portfolio you're inheriting, try to see if you could put them in those different circles. And so we want to make sure that the business or the businesses that we have that are just tremendous go at the center. And the center actually needs to be a very rarefied space. So it's not enough for the business to be great. Like I said, it's very easy to tell. I mean, if I look at the S&P 500, probably 200 of those 500 businesses are great businesses. They wouldn't be in the S&P 500 if they weren't great businesses. So for me to look at the S&P 500 and pick out, which are the best businesses, and in fact, even just rank them best to worst, is a very trivial exercise. It doesn't take much to do that. That'd be pretty easy to do. What would be a much harder exercise is which of the businesses will do the best for an investor from today onwards. Because when a business is great and the markets recognize it as being great, then a lot of those future prospects are discounted in. And so when you become the 201st analyst to buy that business, what are you bringing to the party? It's possible you have some insight that the rest of the world missed. But if these are, widely followed, well understood businesses, those become difficult and rare. So for the innermost circle with the most precious cargo being circled by the, tightly formed wagons, we need 2 or 3 things. We need a tremendous business. We need a tremendous business which has a tremendous growth runway, which has very high returns on equity without using leverage, which has the ability to reinvest capital at very high rates, and which has a very modest price. The last one is the deal killer and the most difficult, because everything else we can find relatively easily. And the last one is why, Munger says we need to go fishing where the fish are. And he also, I think, a few weeks back, there was a Daily Journal annual meeting, I think about two weeks ago, and he was talking about, I think he was asked a question about the single biggest flaw a lot of humans have. And the biggest flaw humans have is denial. A lot of investment managers have denial, where they are going up. I mean, if I am given a mandate to only buy S&P 500 names and beat the S&P by 5 percentage points a year, and I decide to, and I need to have at least 20 names in the portfolio, I shouldn't even try. That would be really hard to do. But a lot of other managers will try that. And that's what Munger means by denial.